Retail sales in Britain rose 0.7% last month, nearly 7 times higher than forecasts. That sounds like good news, but the surge was driven by motorists panic buying petrol, not by confident consumers spending freely. The distinction matters enormously. Since the US-Iran war broke out in February, oil prices have climbed more than 50%. The Strait of Hormuz, through which roughly a fifth of the world's oil supply passes, has become what analysts are now calling Tehran's toll booth. Iran is demanding $2 million per tanker as de facto toll, while US and Iranian gunboats circle each other in a standoff that has no clear exit. A second round of peace talks began this week in Islamabad, but tanker attacks continued during the negotiations. The immediate consequence arrived in UK inflation data. The year-on-year CPI rate jumped to 3.3% in March. Energy and fuel costs are the primary driver, but the effects are spreading. Pharmacies are charging 20 to 30% more for paracetamol than they did in February. Aspirin and cocodamol are running short. Mondi, the FTSE 100 packaging giant, warned its energy, raw materials, and logistics costs have surged. Its shares fell more than 6% on Friday. The company is now passing those costs to customers, with price increases expected to ripple through to the third quarter.
That same energy shock that sent consumers rushing to the pumps is now landing on the desk of the Bank of England's Monetary Policy Committee, and the committee has no clean answer. The bank is expected to hold rates at 3.75% at Thursday's meeting, but hold is not the same as stable. The bank's own decision-maker panel survey, drawn from business owners across the UK, now shows firms expect CPI inflation to reach 4% within a year. That reading is the highest since January 2024. Firms are also expecting to cut employment and narrow sales growth. Wage expectations edged up to 3.5%. Every one of those numbers points in a different direction. The last MPC meeting produced an unexpected hawkish signal. Swati Dhingra, previously seen as one of the more dovish members, opened the door to a future rate hike. Markets immediately repriced. 2-year gilt yields jumped roughly 20 basis points in a single session. Governor Andrew Bailey then had to issue a clarifying statement within 2 hours to calm the move. BNP Paribas now believes the vote will split 7-2, with chief economist Hugh Pill and external member Catherine Mann pushing for an immediate hike. RSM's chief economist Thomas Pugh argued Bailey has signaled no rush to raise rates, and the committee will likely keep guidance unchanged. But Pantheon Macroeconomics' Rob Wood put the tension plainly. Any remaining doves will struggle to hold their position against data showing 4% inflation expectations, while hawks may feel they already have enough to move. The bank's deputy governor for financial stability, Sarah Breeden, added a separate warning this week that equity markets remain overvalued relative to the risks in the global economy, and an adjustment is coming. That is not a forecast designed to encourage risk appetite. FTSE 100 banks are reporting next week. Lloyds Banking Group updates markets on Wednesday. NatWest and HSBC follow shortly after. Citi analysts expect both NatWest and HSBC to beat estimates, but analysts across the sector are flagging a rise in provisions for bad loans, echoing the first quarter of 2022, when banks set aside larger reserves after Russia's invasion of Ukraine. Lloyds already holds roughly £2 billion in provisions for motor finance redress. Its stock, which briefly crossed 100 pence for the first time in nearly 2 decades, has since pulled back as Iran war-related volatility stuck.
The weight of evidence points toward a prolonged UK stagflation episode: low growth, elevated inflation, and a central bank that cannot cut without losing credibility and cannot hike without strangling the recovery. That is the base case, but it only holds if the Hormuz deadlock continues into the summer. If US-Iran talks in Islamabad produce a ceasefire framework and tanker flows begin normalizing, oil prices could retrace sharply. A 20 to 30% oil decline from current levels would bring CPI back toward 2% by late 2026, unlock 2 to 3 rate cuts, and give UK banks the room to reprice lending in ways that support mortgage holders and business investment. The retail panic buying would reverse into genuine consumer confidence. That is the recovery scenario, and it is not implausible. Iran's oil storage capacity is reported to be nearing its limit by this weekend, creating economic pressure on Tehran to reach a deal. The 2 benchmarks to watch. First, whether the Bank of England's Thursday statement carries explicit language about rate hikes at the June meeting. Any phrasing stronger than monitoring would push gilt yields and sterling meaningfully. Second, whether Brent crude holds above the 50% premium to February level through next week, which would confirm that markets have stopped pricing in a near-term deal. The leaning is stagflation risk, but the case flips entirely on one variable. If Tehran blinks before its storage runs out, the entire calculus changes. That is the fact that would prove this read wrong.